Did you know that the national debt, $31.4 trillion, is just a small piece of the total pie? I'm going to explain that today here in this video. My name is David Quintieri, and I have been digging into this information for well over a decade, bringing videos to you each and every day, making it real simple, making it easy. And I wanted to explain something. We've got the national debt, but we also have the consumer debt. And these things are colliding. They are going head first. And you know what happens when two cars smash head to head? It's not pretty, okay? Those crash test dummies go flying out the window. I'm going to give you an explanation as to what this whole debt ceiling nonsense is all about, but more importantly, how this affects you. It will impact you directly. So let's begin. I want to show you something first. The true cost of an extended US debt ceiling standoff. There are the nonsense, political, back and forth World Wrestling Federation type stuff, and then there's actual real threats. Recurring struggles over the borrowing limit undermine the status of the US as an economic superpower. And that's really what this is all about. There's a few things here in this article. I'll only touch on the important stuff. You don't have to read all the nonsense. I wanted to just explain the fact that as time goes on, they are simply going to do away likely with the debt ceiling. And that's the most, I don't think in this round necessarily, but look for that to happen in the future. Warnings about the decline of the American prestige are everywhere. Anything that moves us away from being viewed as the world's reserve currency, of being the safest, most liquid asset in the world, is bad for the American people, bad for the dollar, and bad for the US government. It is so important that we understand this in depth. You see, the fact that there's problems there, that they can't get to an actual conclusion, that looks terrible globally. I mean, that's like what you would find in Europe, where they can't decide on anything, nothing gets done, and things get pushed off decades. That's a European thing. That's expected. There's too many countries, too many different cultures. They can't actually accommodate everybody that's going on, and they're trying to make these decisions from this entity that sits above all these governments. But in the United States, you shouldn't have that issue. There are still well over 300 million people. It's a lot, I understand. But when it comes to this, the amount of spending that they're going to do, it's going to be absurd. It's going to add to the national debt. And yet they fight over it all. But that fight is really just a distraction. You see, they do this in order to allow them special interests to come in. For instance, let's say it's Raytheon or Lockheed Martin, and they want some additional funding because they have an idea for something that should be happening in the Middle East or maybe in Ukraine or something. But you can't get a bill passed to send, let's say, another $50 billion over there, but you can slip something in one of these big bills that won't get read, 4,000 plus pages. You could slip it in there and you can get it done that way. That's what this is all about. It's about the special interests that want to force a bunch of things through, and they can only get that done when there's this back and forth, when they cannot determine what they want. It is an illusion to think that there's a left and right. These are put in front of you just like a magician or an illusionist would do. There's sleight of hand. Look at me over here and watch what happens. Don't watch what happens over here. This is a real situation, and that's why I am trying to show you and explain these details at this level, but only those who stay to the end here are going to figure out all those dots that are connected. Let's go. The administration's negotiating team is fighting against extreme attempts to reverse the progress we've made, creating clean energy, jobs, climate change, lowering the cost for middle-class families, including students, and insulin and other drugs. Wow, really great. The U.S. Treasury Department reiterated Monday it expects to be able to pay the government's bills only through June 1st without a debt limit increase, increasing the pressure on Republicans and the White House to reach a deal in the coming days. They need to lift this at least temporarily, give it an extension of 30 days maybe, okay? And that would allow them to pay their bills. Because why? They are going to pay the interest on the debt before they pay the government services, before they go to the social programs and everything. They're going to put money into the debt. That's how crazy this system is. This debt is owed to itself, and yet it's going to pay that over helping the public. Do you not see a problem with this? That's the first dot we are connecting here and now. Let's go on to the next. More banks could collapse like SVB did because the system favors those who are too big to fail. Of course, there will be another. So you have the debt ceiling, you also have the bank crisis. These two things directly connected with the interest rate hikes. Now, Jerome Powell and others at the FOMC have said we want to make sure that we stop down on inflation, and we're going to do that by keeping interest rate high. The market has been doing so well, as I had told you back in September, that it looked like, at least for the near term, October wouldn't be the bottom. That's how it was. Market's been moving up ever since. Now, the expectation here is that the market believes they are going to be cutting rates in 2023. In my questions to you, in my polls to you, the audience, you have said, not gonna happen. You can let me know if you think otherwise. But that's what we're seeing right here. And now, markets believe in that. Let's go to the next part. You could see the reserves, U.S. reserve balances with the Federal Reserve banks. This has a direct correlation with that green line, which is basically the stock market, okay? The market cap. So, as you see, whenever they pump more money into the system, it has a positive effect on the stock market. Whenever they take money away from the system, it has a negative impact. This is part of the money mirror method that I discuss all the time. Liquidity always adds to this sham of a market. So you follow the money and you make those investment choices. This is no question what I have been talking about for quite some time. And that's how I was able to determine, at least at that moment, given time. I mean, things change every second. But looking like it was a near-term bottom in the markets. And in addition to many others, people who would say that they're, the pros, the gurus. Japan's inflation quickens again, putting pressure on the BOJ, the Bank of Japan. This is just, despite everything, they're going to print more money, they're going to devalue. So if you're, thinking about this long term, I mean, it just doesn't make sense. If you know a country is going to devalue their currency, you don't want to hold that currency, you want to hold real assets. In terms of their stock market is doing very well, but remember there's only one buyer left. So that's what I would say about Japan. Wild currency swings shaved $29 billion off of corporate profits. And the reason I mention this is that when you're holding onto that currency, you got to realize something. That is in relation to other currencies. And if your country has to buy, let's say you're, in Brazil and you got to buy those soybeans, you're going to do that in US dollar, you got a big problem. This affects companies. If the companies make less profit, those companies lay people off. So understand how these currency fluctuations actually impact the companies and then of course the economy indirectly. So that's the next aspect here. I want to show you something else. Will you stick with me? Let's go. Let's move into it quick, okay? This is the part that gets real serious. So watch this. U.S. consumer borrowing climbs on surge in credit card balances, $17.6 billion in March. Total consumer borrowing increased by the most in 4 months. So people are feeling it. The inflation's hitting them, and you could see it corresponding to everything else, auto loans, all that stuff. And so here we have it, rising credit card balances, one of the largest on record. You and I, we're not surprised. We're not surprised about this at all. And yet here we are, okay? So credit cards have gone up, interest rates, this connects to SVB, this connects to what we're seeing with the debt ceiling directly, okay? Let me show you this. Half of Americans won't be able to afford their standard of living in retirement. And what do they say you could do? Okay, you got to prepare early. You got to, invest in your retirement account, and you got to put lots of money in there and have a professional advisor take care of that for you because they really, really care. Most people would do better. I'm not giving any financial advice, but most people would do better by simply putting their money in an S&P 500, like the Vanguard ETF broad index, putting all of their money into that versus giving their money to a financial advisor and going that route into mutual funds and things. 99% of the people would do so better. People who are trying to trade stocks, they're trying to do options. The vast majority, almost every single, like let's say almost 100% of people will fail at that over the long term. They'll gain, they'll do, oh, I'm a stock trader now. And then eventually something happens, either good or bad, and they make the wrong trade and they get that, the result of that. This is a bad situation for many people. Simply investing broadly in the index is probably going to do better for them. And the point here is that we have inflation picking up, and that's hitting the people's bank accounts, and then you're seeing what they're doing. They're putting their money into money market funds because they're saying, I don't know what's going on. Market's been elevating though. Why? Because of those bank reserves, because of the liquidity, because of all that money that's been pumped into the system. It's going through these different means. Now it's running up against the quantitative tightening that's happening with the mortgage-backed securities and the treasuries. So we've got a lot of moving parts here, but that's why you're here with me, and I'm going to walk you through more of these steps. Look, as household budgets tighten, big brands double down on dollar stores. A very interesting article for two reasons. Number one, you could see more people shopping at the dollar stores. That's the busiest place. In fact, in 2019, if you were on this channel, you're aware of this, that the only store really that was opening up, any of these brand stores, you had all the big box retailers starting to close down. There was thousands and thousands of these stores, but the dollar stores were opening up. Okay, and they give you the different, Dollar General and all that, showing you how many stores they've been opening over the years. Another aspect of this is that you are seeing the brands take notice of this later than I think it makes any sense, but they're taking notice. So Kraft is creating products that fit into that dollar store. What can we charge? I guess the $1, $2, $3, whatever it happens to be, a type of product that would go into the dollar store because we're going to create more revenue this way, more sales this way, because the buyer isn't going to the nice places anymore. They're going to the dollar stores now. They don't have the disposable income. They're going to the dollar store. What did that tell you about the consumer right now today? If they had an abundance of money, would they be shopping at the dollar stores? Maybe, but not for their food and things. The whole way that things have been changing has been very apparent. Less shopping at Walmart, more shopping at dollar stores. Interesting. Okay, remember, what does that tell you? Imagine flipping on a light switch and not knowing if the lights will come on. Normally unthinkable, but the EPA is proposing new power plant rules that would destabilize the energy grid, resulting in less reliable energy service. They've got these new aggressive standards for coal, for natural gas, and they're basically saying that, hey, if you want to produce energy, you're going to actually have to do it based on these criteria and all this stuff. It's going to make it more difficult, and as a result, probably going to be less energy. That means you've got to pay more for it. That's the way it's been heading, and I think it's a little bit crazy, to be honest with you, that at this time they're going to these levels when people are struggling, absolutely struggling. Look, even the Bank of Canada sees financial stress rising among homeowners. Why do you think? Connected back to the beginning, rising interest rates. You're looking at inflation picking up. They're not going to be able to get this down because they're not willing to bring up interest rates high enough. And that's what we are dealing with right now here today. What did you learn here? That number one, we're going through an economic cycle. It's getting tougher on, let's say, the bottom 50% of people. It's moderately difficult for the bottom 80 or 90% of people. And then you look at the top 1% who are invested in real assets. They are going to benefit long term. Look at what's happening with real estate. Look at what's happening with real assets in general, businesses. The ones that can persevere through this time are going to do much better in the coming years. That's my message here for today. You want to check out the pillars of prosperity. It is the most important thing that you can learn right now in 2023. Pillars of prosperity. Click it. I'll see you there.